Good afternoon, everyone. Thanks for joining us. We'll give it a couple minutes to fill the room up. Good afternoon, everyone. Thanks for joining us. We'll give it just a minute or two here to fill the room up. Good afternoon again, everyone. We'll give it about 30 seconds to fill the room up here. Good afternoon, everyone. Thank you for joining us once again for our weekly Wednesday webinar series. Today's webinar is on what to expect in 2021, financial and economic outlook. My name is Brett Spitali, and I'm the Vice President of Advancement here at the National Hemophilia Foundation. At any point during the webinar, if you would like to speak, if you'd like to ask a question, please use the Q&A feature at the bottom of your screen. We have NHF staff members monitoring these questions. We will post to our presenter after the presentation. This webinar is being recorded and will be available to the community beginning on Friday, February 19th. I'd like to introduce our presenter today, former board chair at NHF and current board member, Brian Andrew from Johnson Financial Group. Thank you for taking the time to join us today, Brian, and I'll now turn it over to you to get us started, sir.
Okay, thanks, Brett. Appreciate the introduction and also really appreciate the opportunity to be in front of everybody today in the community and spend some time talking about something that I know is on a lot of people's minds, which is what's next for the economy, not just here in the United States, but on a global basis, and how do we think about how that impacts what we do in terms of our work, in terms of our daily lives. And I'm not an economist, just a confession at the beginning. I'm an investor, but in order to be an investor, you have to think a lot about what's happening from an economic perspective. And really, most importantly, how do you get the information that you need to make good decisions? And so I want to share some of that with you today as well. So let's go ahead and get started. I like to always start presentations with my conclusions. So if you're not able to stick around for the whole thing, at least you know what we're going to talk about for the next 40 minutes or so before we get to questions and answers. So, you know, I think obviously everyone is focused on, affected by, and very differently the pandemic. Very differently in terms of how it affects different countries, how it affects families, how it affects individuals. And so as a result of that, the responses to the pandemic have been very different on a global basis, and even different at the policymaking level. And so we'll talk about that today. But I think one of the fascinating things about looking at this from an economic perspective is the fact that we have very different information available to us in real time. And so that has an impact on the way we think about people's reaction to what's happening. And in particular, I think really important because it has a bearing on people's confidence level in the job market or confidence level around the economy. And so really important for us to understand what kind of information is really accessible to all of us to help us understand what's happening as we move through the pandemic and see how the economy is reacting. And so I'll talk about that today. The other thing I want to talk about is the fact that broadly speaking, the economy is likely to experience a rapid recovery, especially in certain segments of the economy. And I'll talk about what those are, why that is, and what we can expect to see for those segments of the economy that probably won't be leaders in terms of improvement and growth, but followers, and how they come along and how long it will take them when we think about that. The other thing I want to point out, and I'll spend some time on today, is the jobs market. The jobs market is very fragmented in the pandemic, and that's because there are industries that are doing extremely well as a result of the pandemic, industries that are recovering well, and then industries that can't recover as a result of what's happened in terms of policy reaction to the pandemic, which is very different in the United States, different at the local level as opposed to the national level, as we see in other countries. But still, we see improvement in the jobs market, which is really important, but it's uneven. And that requires different policy responses. And so I want to talk about what kinds of things we're seeing from a federal government perspective around stimulus and what that means in terms of the recovery. And then importantly, really what's happening in terms of consumers. So that's you and I as individuals who participate in the economy. How are we affected? How are we seeing the recovery? And what does that mean? And why is that even important? Why do we focus on consumers in terms of the economic recovery? And I'll talk about that because we're seeing a tremendous change as it relates to consumers, and something that we all have to pay attention to. Probably think about how we train and educate ourselves differently than perhaps what we've done in the past, and I'll talk about that. And then lastly, this is a global pandemic, and so the U.S. is the largest economy in the world, certainly, but there are economies that are a close number two, as an example, in China, and if you take the Eurozone as a whole, a significant portion of the global economy. And so what happens there matters a lot to what happens to us here and the kind of policy prescriptions that we may see as we move forward. And so we'll talk about the global impact of this, as well as the global impact on the jobs market and what that may mean as we go forward. But I think most importantly, as I go through this, I just want to talk about the fact that a lot of what I'm going to say is in general. So it pertains to the economy as a whole. And I just will highlight along the way the fact that there are different parts of the economy affected differently, different people, different families who are affected very differently. And so while we may see some parts of the economy doing extremely well, there are those that are really struggling now. And so as I talk about stimulus as an example, I'll talk about why I think that continues to get refined because of the different impact on different aspects of our population. But let's start here. I think it makes sense to just understand this at a broad level. And let me be the first to say, especially because I know we probably have medical professionals, I'm not an epidemiologist. I'm not an infectious disease doctor. I've certainly read more than in the last year than I've read in my lifetime about this, but I think it helps just ground us in terms of thinking about what we're seeing from an infection rate perspective, and as we talk about vaccination relative to what that means from an economic perspective. So, as you can see here, this is a representation of the global infection rate using a 7-day moving average. It's pretty easy to see the peak that we experienced at the beginning of January, and since then you can see that we've begun to see a decline in the global infection rate. And I think there's a lot of research being done to understand why we're seeing that decline. Is that just a function of being post the holiday season? Is it a function of the fact that in some countries, and in Europe in particular, we've seen more dramatic closures again as a result of that peaking rate that we saw late December and January? Is it a result of the increase in vaccinations? Probably not, because not that many people have been vaccinated. But point is, there's a lot of information that has to be digested to help us understand why the infection rate has moved down, but it has. And so importantly, and I'll talk about this in a minute, there's a real strong correlation between this information and consumer confidence. And I think that's a really important point, and we'll come back to that a couple of times. So let me just start with a global perspective. So this chart here just looks at the rate of growth of the global economy. Those numbers on the outside are in trillions. And so if you look at the blue line here, it just shows the normal growth rate for the global economy, suggesting that by the end of next year, we'd have been around $37.5 trillion on a global basis. But what happened as a result of the pandemic is that growth rate slowed down, obviously substantially. What you see in black there, though, is the fact that there's been a pickup in activity as a result of economies reopening. Some economies able to control what's happened from a pandemic perspective to the point where they've opened even more. And then even here in the United States, as we've seen a reduction in the infection rate, we've seen a little more openness, and that's led to a slightly faster growth rate. The point of all of that, though, is to say that the economy is about $1.5 trillion smaller on a global basis. And that's why obviously the global pandemic has a meaningful impact on everybody globally. And we'll talk more specifically about what that means. But we know in the United States specifically that we're beginning to see the rollout of vaccinations, and that it's important, obviously, for populations to get vaccinated. It's important for us to share information, specific information about how and where people can do that and why they should do that. And as you can see from looking at this slide, what that's resulted in is an increase in the daily vaccination rate. So that black line is just the 7-day moving average. But importantly, what it shows is that, we've gone from a daily vaccination rate of less than 200,000 to today, I think we're at about 1.67 million. And so as a result of that, we're seeing pretty dramatic improvement every day in the pace at which people are getting vaccinated. So couple that with the fact that we've got a significant portion of the population that's already had COVID, as well as the rollout of this, that has a positive impact on confidence. But again, in pockets of the economy where people are less affected. And I'll come back to this when we talk about policy, there's certainly parts of the economy where the negative impact of the pandemic is dramatic and is still being felt. And we've got to address those issues as we go forward. But we've seen steady progress, and we've had about 48 million doses given. So let me just switch gears and talk about how the pandemic has affected what is actually happening every day. And I think one of the things that's fascinating, which you can see on this slide here, is what I said earlier about being able to get real-time information about people's activity. And that's dramatically different in terms of how we think about getting information to give us decision-making power. And so here's what I mean by that. If I've been doing this a long time, I've been in this business for over 25 years as an investor. And 20 years ago, if I wanted to know how the economy was doing or needed information about the jobs market or inflation, I had to wait for the next government report, which came out once a month or once a quarter. And it took a long time to gather enough information to really have a good picture of what's happening. What you see here is a representation of different countries, including the U.S. in black. And these are mobility indexes. So think about this. There are over 1 billion Apple phones in the world, nearly 1 billion Android phones in the world. And those phones track people's activity. They know where you are. They know if you're going to work. They know if you're going to the grocery store, if you're going to the local park. And so as a result of that, we're able to see in real time every day. You can Google this yourself. You can find mobility tracking information at the local level, at the state level, the national level, and globally. And so what you see here is going back to the beginning of last year, that huge drop off in activity, and then a recovery as we made our way into the summer. And then more recently, you can see that it started to trail off again as we started to see an increase in infection rates. But the important point here is that there's a difference between the US, which is what I just highlighted, and the other parts of the world where we've seen more dramatic closures as a result of an increasing infection rate, which will lead to slower economic activity. And the reason I highlight that is because that's what we're trying to figure out. How fast is the economy growing? How fast will it grow? And then what can I glean from that to make personal decisions and business decisions and the like? And so this mobility information is something that's very different in this crisis than we've seen in the past in terms of our ability to get that information in real time. So let me talk about the job market and just how dramatic a change we've seen. The fact that it's affected some people in a very, very dramatic negative way. And we've got to understand that and think about what we do about that from a policy perspective. I'll come back to that in a minute, but also understand where the economy is recovering and how it's recovering, because it gives us information, number one, about the fact that we can be hopeful about the future. Things are getting better, number one, and number two, this will broaden the opportunity for people going forward. So if you look at this chart, this just looks at the monthly unemployment rate in the United States. And you can see, going back to pre-pandemic levels in February of last year, it was 3.5%. And then as a result of the pandemic and the shutdowns, we saw unemployment skyrocket to 14.5%. And then every month since then, we've seen a slow decline in the unemployment rate to the point where we're now at 6.3%. So that's significant improvement, but we all know that it's very different depending upon what industry you're in, what part of the economy you work in, or your family is in. And as a result of that, we know that this isn't, and again, I'm talking broadly here, we've seen great improvement, but in pockets, there are still significant issues associated with unemployment, particularly in the leisure and hospitality industries. We know that if you look at temporary layoffs, the peak was almost 18 million people in the United States. So that's out of a workforce of 150 million. 18 million people were temporarily laid off. That number's come down to 2.7 million. That's just the number that's measured. So we know the number's a little bit bigger than that, but it's still a lot of people. In addition to that, the other thing that we've seen a big recovery in is in the manufacturing part of the economy, where jobs are actually up almost 1 million from where they were last year. So I talk about that because the consumer, you and I, individuals, are a large part of what drives economic growth. And I'll show you a picture of that in a second. But what's really important is how we think about people's confidence. How confident are they that they can find a job? How confident are they that they can keep a job? How confident are they around their personal income level? So confidence drives a lot of decisions around saving money, spending money, and the kinds of things you spend on. And so we pay a lot of attention to confidence in addition to some of the other activity measures I'll show you. Well, so this shows you pretty clearly that confidence fell off a cliff last year in those categories. And this is an index that's made up of questions around work, income, and spending habits. And you can see we started to see a pickup as we went through the summer. And then as the infection rate went up and closures happened, we saw this decline again. I think what we're just starting to see, and you don't see it here, but we're beginning to see an uptick in confidence. And I think that's really important because it leads to activity. And this is a good example of that. So this is a chart that just shows you the number of people in millions per week who are in dollar stores like General Dollar and Family Dollar and the like. And what you can see when you look at this is that we're sort of back to a number that's pretty close to where we were pre-pandemic. So if I draw a line here, you can see that the average is about the same today, around 45 million people per week in and out of those stores as we were back in 2019. So that's great news, right? You can see that big decline there. And then this recovery, well, that return to the store just means a return of activity. And that's good for the economy, it's good for jobs, and it's good for growth. So we need to continue to see that. This is not the same, however, if you look at other parts of the economy, and let me show you that. So here's an example, if we look at dining. So you can see at the very bottom of the slide, there's a list of the stores represented in this index. Cheesecake Factory, Chick-fil-A, Texas Roadhouse, depending on where you are in the country, but it's meant to be an amalgam of places where people dine frequently. And what you can see is we've gone from a peak of almost 140 million pre-pandemic foot traffic on a weekly basis, down to 30 million, back to a level that's somewhere in the neighborhood of 80 million. Well, that's dramatic, right? Because that means jobs in this segment of the economy. And that's why we know that people who work in this segment of the economy continue to need targeted help as a result of what's happened here. So this is a good example of showing how dramatically we've seen a change in this particular part of the economy. We're a long way from where we were, but we've seen improvement, and that improvement has leveled off. And I think what will happen as we start to see activity pick up, confidence pick up as a result of vaccinations, you'll begin to see this number move higher, and that will be good for the labor force that works in this part of the economy. But nonetheless, it's important to reflect the fact that there's a significant drawdown there. But here's what's really, I think, hopeful in terms of how we look at the future. So this is a chart that just shows the number of job openings that are available. So think about this in terms of classified ads as an example, and places online where you can find work. And this is just a reflection of the aggregation of that. So you can see here that we've had a significant tick up in job openings. So as an example, if you look at Indeed.com, their last month job opening surveys were actually higher than they were a year ago, February, so pre-pandemic. So we're definitely starting to see improvement in the job market, and this opening up is resulting in people being in a position to be able to access those. Whether or not skill sets and jobs are matched is still a question, and I think, frankly, a big policy issue for the United States. I'll come back to that in a second. But this is good news. We're beginning to see job openings listed and people looking for employees, which is great. So now let me talk. There's a lot of numbers on the page. I'm going to highlight just a few of them. I want to talk about stimulus, and I want to try to put in some context the stimulus we got last spring versus what we just got in December versus what's being discussed today. So when the stimulus came out originally in April and May, it was messy. It was hard to get at. It was hard to understand. People couldn't get the unemployment benefits because systems in many parts of the country weren't set up, in fact, antiquated in many cases, and not able to take the flood of people that were trying to access benefits. Same thing is true in the business loan programs that the government passed. Many organizations just weren't set up to process that volume of requests in a short period of time. And so what we saw was kind of a broad shotgun approach to stimulus that eventually made its way out, but with hindsight took too long, wasn't targeted enough or specific enough to help people. So then look at what happened in December. We got another $900 billion stimulus package. And as a result of that, it was more targeted, a little more focused on the individuals who needed the most help and small businesses who are having the most difficult time. So now we're talking about another stimulus package because the economy hasn't recovered. And so if you look at this slide here, the number I'm highlighting is the current president's recommendation for stimulus, that 1.9 trillion we read about every day. And if you happen to watch the town hall last night, you heard him talking about this. And that's compared to, next to it, you'll see this, what says Senate GOP. So that's a bill that was, or proposal that was put forward several weeks ago that was closer to a $600 billion package. And now we're starting to see some conversation about reconciliation. And the number that we're estimating is that we may end up with somewhere in the neighborhood of 1.5 trillion. If you look at these areas across, so I just highlighted state and local government help. So you can see that the president's plan is 350 billion, and on the far right, 200 billion. So where those numbers are close, it means there's likely to be some progress. Where they're not close at all is where there's likely to be less progress. So as an example, if you look at small business help, those numbers are all about the same. Well, that means that in this next package, we will likely get another round of PPP sort of loans, but very specifically targeted to small businesses. As the president said last night, the definition today is businesses with less than 500 employees. And I think they'd like to see that number brought down to make this even more targeted to small businesses. And then finally, if you look at the $15 an hour minimum wage, you can see that the plan has a number in there and there's zeros across the board, and that's because there doesn't seem to be much room to move that forward. However, and I thought this was interesting last night, the president talked about the fact that he's not talking about an immediate change in the minimum wage, but a phased in approach that may actually get more traction and as a result has more likelihood. But when you look at this as of today, it doesn't look like there's much likelihood. And the point of all of that is to say that, that stimulus helps the economy grow. And it's very targeted. And I'll come back to that in a second. We got some evidence today of what happened as a result of the $900 billion that was put out in December. But this is just an easy way to think about it. So I'm going to highlight the middle of this. So if you have $1 trillion worth of stimulus, about 60% of that ends up back in the economy, helping it grow. And it has the ability to move the growth rate by almost 3%. So that's a big deal. And so we're looking this year, if we were to get an additional stimulus package closer to that 1.5 or 1.6, I noted, trillion dollars, that we could actually see the economy growing by the end of the year at 7 to 8%, which would be tremendous from where we were last year in the depths of the shutdown, where the economy contracted by almost 14% as a result of that. So let me just move ahead and talk a little bit about why that matters and what actually happens. So this is just a chart that shows the personal savings rate. And so you can see that on average, the personal savings rate was around $1 trillion a year. And then we had this big stimulus plan. Well, a lot of people were nervous about what was going to happen. And so a lot of that money ended up in savings. And then you can see it slowly made its way back out into the economy. So now, again, people have a little more perspective. They have a little bit better understanding of where we're headed as a result of where we are from a reopening, vaccinations, et cetera, planning perspective. And so we're likely to see that savings push itself out into the economy more quickly. So when we talk about this rapid recovery in the later part of the year, that's really a function of saying this is fuel, if you will, for the economy. It creates jobs. It creates spending, which creates jobs. It creates economic activity, which helps the economy grow. And so there's almost $2 trillion essentially on the sidelines waiting to make its way back into the economy. And that's a good thing when you think about the pace of recovery as we get later into the year and toward something that's more open than we have today. And you can see this here. So I want to just call out this specific area because I think this is a really important point, and I think it's a hopeful point where when we think about what's happened from a pandemic perspective, we sort of have to separate the near-term effect of the pandemic on activity with some really big secular trends that are affecting different parts of the economy, and then really understand the differences, because not everybody is affected the same way, and those that have can help those that don't, and that's how we have to really think about this, I think. But here's an example of what I mean about a long-term secular trend. So for many years, the housing market has been pretty flat. And the reason for that is that we just haven't seen the new entrants into the market making their way into the housing market. That's important because housing by itself is about 4% of the economy. If you add the sort of multiplier effect that happens when people buy a house and want to fix it up and maybe go to Home Depot or Lowe's more frequently, that number is actually quite a bit higher than that. So what I'm showing here is that if you look at the chart, you can see that the rate of building permits has gone up to like 1.64 million. And a lot of that has to do with that line that shows the decline in interest rates. So interest rates have come down, building permits are up, but what's really important is deeply behind that is you're seeing an increase in home formation. And that's a function of this very large portion of our population we refer to as millennials, essentially entering the housing market. So this pandemic will negatively affect many, many people in the housing market, people renting in particular who are struggling to find a job. And it's important to think about what that means from a policy perspective. But I mentioned this backdrop that's positive because as people enter the housing market, as this new generation enters, you see development. That development leads to that consumption I was talking about, which ultimately creates more jobs. And so I think a long-term secular trend, as the average age of that $75 million, 75 million person age group is still only about 28 or 29. And so I think this is a long-term trend that will continue to be a benefit for the economy. So this just real quickly, I wanted to show you why this is important. These little pieces of this bar that I'm showing you represent what makes the economy move. And you can see that the biggest piece of that, the blue piece, is the consumer. And so as a result of that, it's 68% of the economy. So everything I just said about consumption and consumer confidence and foot traffic in terms of stores and dining matters because it really moves the economy, has the ability to create jobs and improve everyone's situation. So one more reason to be hopeful about this acceleration and growth later in the year has to do with the idea of creating pent-up demand. So if you think about the pandemic, there are a lot of things that we haven't done, haven't been able to do, that we've either put off, maybe won't do it all, but more likely put off. And that pent-up demand eventually gets released as more and more people get vaccinated and we come out of the closures that we have. And this is just an example of that. So this chart here looks at the number of elective surgeries and operations that were had versus those that were postponed. And so let me just highlight for you in the middle, that's North America. And you can see if you look at that slide that almost 4 million operations were canceled as a result of the pandemic. So one of the areas, interestingly, that saw the most of this was in the orthopedic world. People who need a new hip or a new knee, maybe were concerned about going to the hospital and recovering, rehabbing, and so as a result, put that off. Well, that creates this sort of pent-up demand because those people still need those surgeries to get back to where they'd like to be. And as a result, that pent-up demand eventually gets released. And as a result, you get this increase in economic activity. And again, that means people are back to work. Job openings continue to move higher, and a reason to be hopeful about where we might be down the road, say 9 to 12 months. The other thing I would note about that is that that's not a US phenomenon. That chart was a global chart. And so when you look at it in the aggregate, it's literally tens of millions of procedures that are sort of now on hold that will eventually make their way back into the market. The other area where we see this is in education. And I think this is probably the one area from a policy perspective that we just all need to continue to push on so that we get better policy around education. And I say that because earlier I talked about the number of jobs that are available. And one of the challenges is that the skill sets people have don't always match the jobs that are available. And education is how you close that gap. But one of the things that happened as a result of the pandemic, and you can see that here, is that post-high school education enrollment dropped, and most dramatically for people over 24. And I think that's because a lot of those people who would enter that market are the people who lost jobs, lost income, and are having difficulty. And so as a result, they're just not able to enroll in post-high school education. But across the board, even if you look at high school graduates entering college as an example, that was down 22% last year. But my point in bringing that up is that I think the upside of that is that in the future, that means pent up demand for that education that will close the skills gap. And I think that's tremendously important, but also tremendously important that we all pay attention to policy related to education, because we need to close that gap in order to get more people into the workforce. And you can see the result of this and sort of the inequality of the pandemic in this slide here. So this looks at the top 10% of pre-tax national income, those that earn in the top 10% bracket, and their share of spending on an after-tax basis, and what percent on a national basis do they have. That line going up shows the inequality from an income perspective, where we've gone from about the top 10% having a third of national income to having more than half. And one of the primary reasons for that goes back to this idea that there's a skills gap and there's education needed to close that gap to get people into jobs that will ultimately produce better outcomes for them. I'll talk about that in just a second, and one way that we've seen a change in the pandemic that may help that. But this is dramatic and meant to be dramatic in terms of my bringing it up, because when you look at this chart, it's pretty easy to see why we have some of the issues we have from a political perspective, why we have some of the divisiveness that we have. And it's something that we've got to think about in terms of what it means from a policy perspective. And I bring this up to say there are lots of reasons to be hopeful about economic growth, but we need to think about some of these longer term policy issues and how we work at them to get us to a better place as a nation. So let me switch gears and just talk about the manufacturing part of the economy. And by the way, I've seen a couple people raise their hands. We're going to do questions when I get to the end here in just a few minutes. So there'll be plenty of time to get to those. So I just wanted to point out, because manufacturing is an interesting part of the economy. It's only about 18% of the US economy. It's in the midst of a tremendous recovery. And as a result, we're seeing job growth. I mentioned earlier that we've produced almost 800,000 jobs in the last 11 months, specifically in this part of the economy. And that's important because manufacturing jobs tend to pay 40 to 60% more than other parts of the economy. That green line there measures PMI, or purchasing manager activity. So if you're a purchasing manager for a company, you buy the materials and the services that are needed to make what that company makes. So the more activity purchasing managers have, we measure that. This line goes up, and that means future growth in the economy. I wanted to pull this out just because I think it's really important to note that number in December was as high as it was in 2018 and 2010. And after those 2 years, we had some of the fastest economic growth we've had in the last 2 decades. So that's a really hopeful perspective to see that number going up. And it's not just the United States. So China is the second largest economy in the world, something we have to pay a lot of attention to, because especially in manufacturing, if China's growing, that means the rest of the world is asking the world's manufacturer in China to help with that activity. And you can see that the growth rate every month has continued to go up, and we're up over 7%. And so even on a global basis, we're seeing this big recovery in the manufacturing part of the global economy. So I just want to switch gears one more time, and then we'll get to questions. So I think this is really important. So, I think about this from my own personal perspective. If you have ever dieted, or if you've started a new workout routine, you know that you have to get after it day after day after day. And you have to do that long enough for that new thing to become a habit. And I think one of the most fascinating things about this pandemic is that there are things that, had the pandemic last 2 months or 3 months, those things wouldn't have become trends. They would have been temporary. But when something goes on for a year or a year and a half, perhaps 2, then you start to see those things that are temporary become more permanent. And so that means new winners, as an example, in the economy. And this is just an example. So because I think it's a great example of what's changed. So this just looks at electricity generation in different parts of the world and how much comes from wind. And you can see if you look at the blue line, that's the United States. I know there's a lot in the news about wind turbines freezing in Texas, but I don't think that's going to change this secular trend as a result of what's happened in the last couple of days. What's important, though, if you look at the Northeast in the United States as an example, there's over $40 billion worth of offshore wind projects that are ready. And so I think this is an example of how people have evaluated differently as a result of the pandemic and a reduction in global economic activity. We've actually seen a change in certain aspects of how we measure climate to know that this is probably a good thing. And so it's an example of a trend that's not going to reverse itself. If anything, may actually accelerate. And there are other things around these new habits that we have that will change the way people work, change the way they think about where they work, and how things get done. And I think that's beneficial for people who are looking for work and thinking about where they can find it, to think about looking in different places, number one. And number two, from a policy perspective, understanding that we have to give people different opportunities. Something as simple as having broadband and the availability of internet, as an example, is critically important in this new economy. And this new economy just grew by a substantial amount as a result of us being able to do this, communicate online. So if you look at this, 34% of the workforce in the last year has worked from home. So out of 150 million people, 34% have worked from home. 15% indicate that they would just as soon not go back to the office. They'd like to stay home. We use tools like Teams and Zoom and WebEx to communicate with our family and friends and for work. And that's become now a habit. So it's not temporary anymore. It's just part of who we are. But that means that we need to think differently about how we can help people, because the trends associated with this are really, really critical to where you find jobs and find work. So I thought this was interesting. Half of millennials use the gig economy in some way, shape, or form to find work. But this is what I mean about changes in our policy thought process. Almost half of people who work in the gig economy have no employee benefits. And on average, the pay in that economy is almost 60% less than people who work full time. So this permanent change in the way we think about work and where it's done and how it's done needs to mean that we change some things about what we think about from a policy perspective. But I think most importantly, it's something we can take advantage of. And we will continue to see people take advantage of. And that's why I said earlier, I'm hopeful about what that means in terms of broadening the labor market for more people and making it more available. But obviously, we have to create the tools for people to be able to utilize and plug into that economy. We also need to change laws in the way we think about benefits, as an example, and the availability of benefits to people who are participating in the economy in a different way than they have in the past. So one last thing, and then we'll take questions. So I think this is really a fascinating evolution, which we've seen a significant uptick in as a result of what's happened in the last year. And that is how we think about education. So I know a lot of people have struggled with kids staying home, being educated from home. President talked a lot last night about the need to get kids back into school, especially K-8 kids. And we all know that's right. And we've got to continue to work toward that. But as we think about that 24 plus crowd I talked about, we have to also understand that education isn't just going to a building, going to a community college. There are a lot of ways to educate yourself. And as a result, we're seeing a major difference in how education is treated. And I've just listed a few examples. I think the first one is probably education is entertainment, more so than the other two. But the point is that there are a lot of opportunities for education that are very different, that produce different outcomes for people. And importantly, technology is a good example. The technology industry sees this, and they're beginning to shift away from 4-year degrees to specific certificate programs for people to program, or computer engineers and the like. And so I think that evolution of education is something people have to get smarter about, think about. We have to think about what that means in terms of where we invest and make decisions about who's growing and who's not, because we're just in a very different time. But it's also a reason, I think, to be hopeful in terms of where the economy is headed from here. And so let me just close with that, and then we'll take questions. So like I said, I think we have much better information than we've ever had. So we feel better about being able to see into the future what's happening. Most of the information I shared with you today is public information. Anybody can get it. We do see a more rapid recovery later this year, which is a reason to be hopeful. And we see an improving job market throughout this year and into next. And then it's important to just follow consumer trends because, like I said, they're 68% of the economy, so really important. And then the other thing to think about is this is a global pandemic, but it also means that the recovery I'm talking about in the United States is global in nature. It will be different in different parts of the world because, as an example, vaccines are not as broadly available in some places as they are in others. But nonetheless, we'll see improvement. And then I think from a policy perspective, we've got to help our policymakers think about how changes in education, changes in healthcare, certainly for this community, impact not only the availability of jobs, but the way that we think about accessing what gives us new opportunities. And I think that's really important. And then lastly, the pandemic has created some significant change in all of our lives. Some of that will go away and we'll go back to what we call normal, new normal. But much of it is permanent. I have an 88-year-old mother who several months ago learned how to use Zoom and now loves to use Zoom on a regular basis to talk to her family. So I don't think we're going to stop doing Zoom calls because we live all over the country and she loves putting them together. So that kind of permanence, I think, will be an important thing for us to consider as well. So those are my comments. I'm going to turn it back to Brett, and we're going to just take some time to go through questions.
Great. Thanks so much, Brian. We do have several questions that came in, but just before I get to that, I'm going to launch a quick demographic poll. If you're out there and if you don't mind participating in the poll, we'd certainly appreciate it. First question that came in, Brian, is do you see situations like GameStop continuing to cause minor disruptions in the market?
Yeah, so GameStop feels like it's new because it got a lot of press. The idea of investors pushing other investors who've shorted company stock is not new. What's new, so first of all, for those that aren't familiar with that, when you short a stock, it just means you sell stock you don't have with the hope that you can buy it back in the future at a lower price. So shorting stock means you want the price to go down. What's different is that I think, and not different across the board, but different in investing, is just the fact that people, first of all, were able to use a social media platform that's been set up to invest, to create a group of people who wanted to accomplish something. So that's difficult. And we all know, and this is not just true in the investment industry, most industries, it's hard for regulation to keep up with technology. And so we'll see regulation change, but that sort of social media platform for investors is new. So it causes a disruption in a handful of stocks, but it's not something that really disrupts the market overall.
Great. Thank you, Brian. Next question comes in. With the talk of student loan forgiveness, if that comes to fruition, what is the downside, if any, to the economy?
Yeah, so I thought it was interesting last night. One of the questions the president got was about student loan forgiveness and the idea of raising his $10,000 proposed number to a $50,000 number. And at least he was pretty adamant that he wasn't going to go that far. I think he's more interested in not only the $10,000 forgiveness number, but forgiving interest on outstanding debt. So I think, one of the reasons we're even having this conversation is because student loan debt wasn't really something that was nationalized before. Now the majority of student loan debt is backed by the federal government, as opposed to outside of the federal government. And so the government is a position to use a policy tool to do something there. So I think from a stimulus perspective, there's a lot of benefit to thinking about how that might work. From to your question about what effect does it have on the economy, it really helps people who probably need it most. So it's one of those targeted things that we can do. But it also changes the way we think about higher education, and there's probably more debate needed around that before we change policy.
Great. Thank you, Brian. Next question comes in. How do you feel the lack of vaccines in most countries and how long it will take to get everyone back to normal impact the economy?
Yeah, I think that's a great question. And I think maybe a theme through this whole presentation is that one of the things that the pandemic has created, even a bigger divide around, are people that are doing well versus people that are not. And I think as a result, it's got to create more social awareness on the part of everybody, to know which side you're on and how you're going to help yourself and help others. So I think the vaccine is a good example, because we know that in the United States and in many countries in Europe and in larger countries in Asia, countries have ordered significantly more vaccine than they need. Partly because they're learning as they go, but I think also partly because the expectation is that they'll use that excess vaccine, or I should say give that excess vaccine to countries that just don't have the financial wherewithal or the capability. How that plays out is something I think we're going to have to wait to see, but the point is valid, that it means the recovery that I'm talking about will likely be first in those countries that are able to get more vaccine out to their populations more quickly.
Great. Several questions coming in here, Brian. Next one, does the size and trajectory of the public debt concern you and impact your investment plans?
Yeah, so I love that question, because I don't, I do probably 40 or 50 of these a year, and I get asked that question every time. So, and why I think that's great is because it means people are paying attention. And yes, it does concern me. It concerns me a lot because in the last 4 years, we've raised the deficit by $7 trillion. We're talking about raising it by another, 1.5 to 2. And we need that help, that targeted help. So I'm not suggesting we don't get it, or we don't do the stimulus. I think we need to. However, we've got to think about, and I said earlier, we may see the economy grow at 7 to 8% later this year. I talked about millennials, the 75 million people who will create probably the growth in this economy in the US like we saw in the 90s. So we had budget surpluses in the 90s. We've got to see a change in policy to take advantage of that same faster growth rate to get back to that. Otherwise, we continue to compound the problem, and that eventually will be a more significant issue down the road.
Great. I'm just going to go rapid fire here with you, Brian.
Yeah.
No one comes in. A great question. It is known that women have been significantly impacted by the pandemic, in that they have left their jobs or lost jobs, and many are at home taking care of children, schooling from home, etc. What is the projection of their ability to get back to the workforce at the same level as before, or better? What long-term impact do you think this will have on our economy and households?
Yeah, that's an excellent question. I'm sure I don't have a great answer for that question, but I go back to a couple things that I mentioned, and I talk about this all the time because I feel like it's so important for each of us individually to create focus on this, that we can't have the same policy prescriptions to help people that we had 20 years ago today, because the economy doesn't work today the way it did 20 years ago. So those last couple slides I talked about in terms of how and where people can find work, how and where they can do work, are very different today. How even they educate themselves to close a skills gap to get into a particular part of the labor force is very different. And so we need to continue to push policymakers and each other to think differently about how we make that happen. And in particular, because of the question asked, there's no question that as a result, in particular, of children having to school from home, that people have been negatively affected, and women probably more so. And so as we think about, and this goes back to what I said about stimulus, we just need to continue to have more targeted help, less broad strokes like we had last spring, more targeted help, but different than what we've seen in the past.
Great. Next question comes in. What policies do you believe can best address the growing wealth gap in the U.S. and the division that we have in the U.S.?
Yeah, so that's a great question, I think, related to what I just said. I think that and I use, because I think it's such a simple example. I don't know if any of you saw this story in the last week. An individual who lived in a suburb outside of Hollywood, California, actually paid $10,000 to put an ad in the Wall Street Journal to get AT&T to move his broadband to a more reasonable level, because he literally couldn't work from home because the broadband was so slow. That's, to me, that's in a major metropolitan area. To be in a situation where he was at 100 times below the normal level is an example of where, we talk about what we're spending money on. As an example, from an energy perspective, something as simple as just getting people uniform and faster access to broadband would help with healthcare, because people can use telehealth. It would help with education, because people can educate themselves differently, and ultimately close the skills gap that allows people to get employed in the new economy.
Great. Thanks.
Sorry, that's a passionate issue of mine, so I was probably editorializing a little bit there, but
no, I think that's great. I think it's great. We can see that come through. Next question comes in. You mentioned the housing market. Would you say now is a good time to buy a home because of the low supply and interest rates, or should you wait because of a housing bubble might burst?
Yeah. So I think, so now I'm going to put my investor hat on. I don't think individual homes are a great investment. I think it's an important foundation for families. And when I say that, what I mean is, unless you're a flipper and you're trying to make money by proactively investing in residential real estate, it's more about creating that foundation. And to the question, it's a phenomenal time. Interest rates are as low. So I've been doing this a long time. I said over 25 years. I think I remember when mortgage rates were between 12 and 15%, and today they're below 3%. They will likely move higher over the next 5 years. And so it makes housing more affordable because the cost of money is so low right now. So from that perspective, I think just thinking about it in that context, it makes sense.
Great. A couple more questions that have come in. Can you briefly talk about planned giving and maybe some of the advantages of that?
Yeah, so that goes back to one of the things I said earlier about people who have, thinking about people who don't, number one, and number two, part of what we do is help individuals plan for their wealth and how to use their wealth to tell their story about their values, about their family, about what's important to them. Planned giving is an excellent example of how you can think about using that. It has benefits from a tax perspective. It has benefits because it allows you to use portions of your estate that might be expensive from an estate tax perspective. So it's a great tool from a planning perspective. So it makes sense from a planner, it makes sense, but it's also a way for you to extend your values and support causes that are important to you. So it makes a ton of sense. If it's not something you know a lot about and you have wealth and you've thought about it, it's worth getting up to speed on.
And you can also visit plannedgiving.affiliate.org as well, too, if you'd like to have some more questions answered about NHF. We've got a great site for that, too.
Thank you.
the shameless plug there. But
All right.
there's a couple more questions. We're coming against the hour, but we still got a good amount of people on, Brian. So
I'm
I'm just going
good.
to keep going.
Yeah, I have time.
Um, do you see the decline in post-high school enrollment as having a positive or negative impact on the economy as job opportunities start to increase?
So I think that's a question we won't know the answer to for some time. And here's why I say that. I think going back to the trend I was talking about earlier, you probably have noticed a lot of advertising for certificate programs. And there's a couple of reasons for that. But in particular, when you look at programming as an example, people who program in a particular language, as I said earlier, there's such a strong need for a particular skill set from the technology industry that they can't really wait for four-year schools to mint graduates to fill the need that they have. And so they've come up with programs that allow people to learn online, as an example, a specific skill in a much shorter period of time, 8 to 12 weeks, and at a much lower cost. And once they have that skill to be employed. And so one of the things you're seeing is, because there are these skills gaps, is the private sector actually getting more creative about how they educate people. And that's interesting, because if you think back decades, really large companies used to train their employees to do lots of things, and education around that was essentially on site. And that sort of went away. And now we're seeing a return to that. So that's why I say I think it'll be hard to measure. But I don't think that's a bad thing, because I think it will allow people to get into the workforce more quickly.
Great. Another question that came through. I'm not sure if you'll have all the information you need to answer this, Brian, but let me shoot it out to you here. Do you believe SpaceX, through the Starlink project, will have a negative impact on broadband, or do you think it will increase competition?
Yeah, that's an excellent question. So I'm not sure that's another one of those questions we probably won't know the answer to until after we're up and running. But it is an example of thinking differently about what we need, right? So the project is to try to create a broadband link for people who live in remote areas, and certainly have much less availability, and that has the opportunity to provide value. Probably what's concerning about that is that it's privately owned. And so that creates all kinds of policy issues about who gets to participate and who doesn't. And frankly, I mean, that I would put it in this context, that's no different than the policy debate we're having today about social media companies. They're private companies. They should get to make their own rules. But when you have 1 billion users, or more, 2 billion users like Facebook, then that starts to feel like the community square, and we get uncomfortable with private companies having that much power. And I think we could end up in a similar situation from a broadband perspective.
Great. Another question that came in. How do you think the stimulus and money coming off the sidelines will affect inflation?
Yeah, that's the sort of big question everybody's wrestling with. And so here's some math I try to pay attention to. So inflation comes from two things. The bad kind of inflation is, the worst kind of inflation is where there's too much demand. So this is the GameStop analogy, right? So if there's too many people trying to buy a stock that doesn't exist, the price goes up to a ridiculous level. So that kind of demand inflation is bad. If you think about that chart I showed you that showed personal savings, so we had stimulus, and then personal savings went from 1 trillion to 3.6 trillion. What that means is a lot of the money that went out, not specifically in the form of checks, but in many other forms, ended up in savings accounts or bank accounts, not into the economy. And so that's just people saving because they're worried, they're reducing their risk. If that money goes out quickly, it will create inflation. But if it goes out over time, as we're suggesting, over the next 2 or 3 years, that'll be good for the economy, but it likely won't lift inflation as much as people are concerned about today.
Great. looks like that's all the questions that have come in, Brian. And
Okay.
I know we're past the hour here, so I'd like to thank you for taking the time to join us this afternoon. We certainly appreciate your time and expertise, and I'd also like to thank each of you for joining us. Please note that this recorded webinar will be available on Friday, February 19th at hemophilia.org under the Events tab with all of our archived webinars. Also available in the Events tab is our upcoming schedule for our weekly Wednesday webinar series. Thanks once again, Brian, for joining us. We appreciate it. And thanks, everyone. Have a great day.
All right. Thank you, Brett. Thanks, everybody. I appreciate it.